A bigger retirement account does not always mean you are richer. It only means the number on the screen is bigger before the full bill has been paid. Jake and Marcus both start at 28 years old. They both earn $75,000 a year. They both decide to save $500 a month for retirement. Neither one is careless. Neither one is chasing a quick win. Both of them believe they are doing the responsible thing. The only difference is where the money goes. Marcus chooses his employer's traditional 401k. His company offers a match. In this example, the company matches 50% of his contributions up to 6% of his salary. At a $75,000 salary, that match adds about $187 a month. So Marcus does not have only $500 going into retirement. He has about $687 entering the account every month. Before the market earns anything, Marcus already has more money working for him. He also gets a tax break today. Because his traditional 401k contribution is usually made before taxes, his taxable income is lower now. Assume he is in the 22% federal tax bracket. A $500 contribution may feel closer to about $390 after the tax savings. That feels powerful. Marcus is saving more, but it feels like he is giving up less. His employer is adding money. His current taxes are lower. His account balance is growing faster. If this were only about the first few years, Marcus would look like the clear winner. Jake chooses a Roth IRA. He also saves $500 a month, but his money goes in after taxes. There is no employer match. There is no tax deduction today. There is no immediate reward on his paycheck. Jake feels the full cost of every contribution. At first, his choice looks worse. His account is smaller. His paycheck feels tighter. His balance grows from a smaller base. If Jake and Marcus compare statements after the first year, Marcus has the more impressive number. That is the first trap. The statement balance feels like the scoreboard, but it is not the final scoreboard. It is only the number before the tax question is answered. Inside the accounts, the investments may grow the same way. A dollar invested in the same fund does not care whether it sits inside a 401k or a Roth IRA. If both accounts earn the same return, the market growth can be similar. The difference is not how the dollar grows. The difference is what happens when the dollar comes out. Marcus receives the tax break today, but the IRS does not disappear. It waits. Every dollar he contributes before taxes may eventually be taxed when he withdraws it in retirement. Every dollar of growth may also be taxed as ordinary income when it comes out. Marcus's 401k has a silent partner, the IRS. It does not show up beside the balance. It does not make the monthly statement look smaller. It does not take money today. But part of that future balance may not fully belong to Marcus. Jake's Roth IRA works the opposite way. The IRS takes its cut before the money enters the account. That hurts today. But if Jake follows the rules for qualified withdrawals, the growth can come out tax-free later. Marcus delays the tax bill. Jake pays it early. That one difference changes the entire story. After 10 years, the surface comparison still favors Marcus. He has contributed $500 a month, and his employer has added about $187 a month. Together, that is about $687 going into the 401k every month. Over 10 years, his total contributions, including the match, are about $82,440. Assume a 7% average annual return for illustration. This is not guaranteed. Under that assumption, Marcus's 401k balance is roughly $114,000. Jake contributes $500 a month with no employer match. Over the same 10 years, he contributes $60,000. With the same assumed return, his Roth IRA grows to roughly $86,000. On paper, Jake is behind by almost $28,000. Most people would stop there. They would say Marcus made the smarter choice. And if the only number that matters is the visible balance, that answer makes sense. But the visible balance is not the spendable balance. If Marcus eventually withdraws that 401k money and pays taxes on it, the $114,000 is not entirely his. Assume, for illustration, that he pays a 24% effective tax rate on withdrawals. The after-tax value would be about $86,640. Jake's Roth IRA is about $86,000. But if the withdrawals are qualified, that money is already after-tax money. Suddenly, the gap almost disappears. The account that looked far bigger is not nearly as far ahead once taxes enter the picture. Marcus still benefits from the match, and that match is extremely valuable. But Jake was not as far behind as the gross numbers suggested. This is the part most people miss. You do not spend your gross retirement balance. You spend your after-tax retirement income. Marcus has more money on the statement. Jake has cleaner money. Marcus has relief today. Jake has control later. Marcus has employer money. Jake has more flexibility with his Roth IRA contributions. Neither one is automatically wrong. They are buying different things. By year 5, Marcus feels rewarded. His account is larger, his taxes have been lower, and his employer match makes each month feel like a win. The system encourages him to keep saving. Jake has a quieter advantage. His account looks smaller, but the tax bill has already been handled. His Roth contributions may be more accessible in an emergency, though retirement money should usually stay invested. The benefit is less visible, but it is real. This is why the story is not an argument against the 401k. The employer match can be one of the strongest advantages in personal finance. If Marcus ignored it, he would be leaving valuable money behind. But after the match, the real question begins. Should every extra dollar still go into the 401k, or should some go into a Roth IRA? That is where the decision becomes more than a balance comparison. It becomes a tax timing decision. It becomes a flexibility decision. It becomes a control decision. And this is why the decision feels simple at first, but becomes complicated over time. When people compare these accounts, they often ask the wrong question. They ask which balance is bigger. But the better question is, which balance gives them more usable money, more flexibility, and more control when they finally need it? And the answer will not be obvious until decades later. Now fast forward. Marcus's career goes well. In his late 30s, he gets promoted. In his 40s, he earns more. By his mid-50s, assume his income is around $140,000 a year. That is good news, but it creates a new tax question. When Marcus was 28, the 401k deduction felt like an easy win. He avoided taxes on the contribution in that year. But if his income rises, and if tax rates later are different from what he expected, his future withdrawals may not feel as cheap as his early deduction felt. That is the uncertainty inside the traditional 401k. Marcus knows the tax break today. He does not know the full tax bill decades from now. Jake faces the opposite trade-off. He paid taxes early when the contribution felt heavier. But as his income rises, the Roth money becomes easier to understand. If the withdrawal is qualified, the number he sees is much closer to the number he keeps. Later in life, control also matters more. Traditional 401ks have required minimum distributions. That means Marcus may be forced to take money out at a certain age, even if he does not need it yet. Those withdrawals can increase taxable income and may affect other retirement costs. Jake's Roth IRA generally does not have required minimum distributions during the original owner's lifetime. That gives him more control over when to use the money, how to manage taxable income, and how long to leave the account growing. Now, look at the long-term numbers. Assume both men keep contributing from age 28 to age 65. That is 37 years. Assume again a 7% average annual return for illustration, not as a promise. Marcus contributes $500 a month, and his employer adds about $187 a month. Together, about $687 enters the 401k every month. By age 65, Marcus's 401k balance is about $1.62 million. Jake contributes $500 a month into the Roth IRA. With the same assumed return, his Roth IRA grows to about $1.178 million. At first glance, Marcus is far ahead. His account is larger by more than $400,000. That looks decisive. But Marcus's number is still pre-tax. If he pays a blended 24% effective tax rate on withdrawals, the after-tax value of his $1.62 million is roughly $1.231 million. Jake's $1.178 million Roth IRA, if qualified, is after-tax money. In this example, Marcus ends slightly ahead in after-tax dollars, but the reason is important. He is not ahead simply because the account is a 401k. He is ahead because the employer match added extra money for decades. The match is doing much of the work. Without it, the Roth IRA would look much stronger in comparison. That is the hidden lesson. A 401k is not automatically better. A Roth IRA is not automatically better. The real answer is usually about order. First, if an employer offers a 401k match, it is often worth considering enough contributions to capture the full match. Skipping the match can mean giving up money that was available only because you contributed. Second, if you are eligible and can save more, a Roth IRA can add something the 401k may not provide in the same way. Tax diversification, contribution, flexibility, and the possibility of tax-free qualified withdrawals later. Third, if there is still more money to invest for retirement, the 401k can continue to be useful, especially because workplace plans often allow higher contribution limits than IRAs. But this is not a universal rule. It is a thinking framework. The right choice depends on income, current tax bracket, expected future tax bracket, cash flow, age, discipline, risk tolerance, retirement plan options, and personal circumstances. That is why simple answers can be dangerous. Saying 401k is better is too shallow. Saying Roth IRA is better is also too shallow. The better questions are different. Do you have an employer match? Do you need tax relief today? Do you need flexibility? Are you trying to reduce today's tax bill? Or create more control in retirement? This is the real money logic. A retirement account is not just a container. It is a deal. The 401k deal may give you tax relief today, employer money, and more contribution room. In exchange, future withdrawals may be taxed, and later rules may require distributions. The Roth IRA deal makes you pay taxes today. In exchange, qualified withdrawals may be tax-free, and you may have more control over when the money is used. Both deals can be powerful. Both can be misunderstood. Marcus was not foolish for choosing the 401k. He captured employer money and reduced taxes today. Jake was not foolish for choosing the Roth IRA. He paid the tax bill early and built a cleaner pool of future money. The mistake would be believing either account is automatically superior in every situation. The real battle is not 401k versus Roth IRA. It is now versus later. Tax break now or tax break later. Bigger gross balance or cleaner after-tax balance. Employer match or future tax control. Higher contribution room or more accessible contributions. That is the decision underneath the decision. So the smartest question is not, which account is better? The smarter question is, which account is better for this next dollar at this stage of life under these tax assumptions? That question is harder, but it is more honest. Because financial decisions are rarely about one number. They are about trade-offs. What you gain, what you give up, what you control, and what you may owe later. A bigger account does not always mean you are richer. A smaller account does not always mean you are behind. The real scoreboard is the after-tax money you can actually use. So what is the practical choice? If your employer offers a 401k match, seriously consider contributing enough to receive the full match. After that, if you are eligible and able to save more, a Roth IRA may be worth considering as a future tax flexibility tool. If you still have more to invest, the 401k may continue to be powerful because of its higher limits. Use that as a framework, not a law. Choose because you understand what you are buying. Are you buying tax relief today or more tax control later? Are you chasing the prettiest balance or the most useful after-tax money? That is how long-term wealth builders think. They do not get fooled by the statement balance. They look at the whole system behind the money. Sometimes the most expensive financial decision is not the one that looks wrong at the beginning. It is the one that looks smart until the hidden tax layer finally appears. So, if you were Jake or Marcus, which side would you choose first? Would you take the 401k match and build from there? Would you prioritize Roth IRA tax-free growth? Or would you try to use both in the right order? Comment below, because the answer usually reveals how people really think about money. And if you want more breakdowns like this, subscribe and follow Money Logic. Here, we do not just look at the surface number. We look at the hidden logic behind financial decisions that seem simple at first. This video is for educational and entertainment purposes only. It is not personal financial advice. Always do your own research and consider speaking with a qualified financial professional before making major financial decisions.